There is a moment that happens to almost every renter at some point, usually late at night, scrolling through property listings they cannot yet afford, where a quiet, unsettling thought surfaces. What if I am falling behind? It is not a rational calculation in that moment. It is something older, something emotional, the feeling that time is passing and nothing permanent is being built. That feeling is not an accident. It is the product of decades of cultural messaging, financial industry incentives, and a psychological framework that was carefully constructed around one central idea, that owning a home is the only legitimate path to financial adulthood. What makes this worth examining is not whether home ownership is good or bad. It is that most people never actually run the numbers. They absorb the idea of ownership as inherently superior, and then they make one of the largest financial decisions of their lives from inside that assumption, never questioning whether the math actually supports the emotion driving them. The psychological mechanism at work here is called loss aversion, and it operates in a very specific way when applied to housing. When a renter pays $1,800 a month and receives shelter in return, the brain registers that transaction as a loss, money gone, nothing to show for it. But when a homeowner pays $2,400 a month toward a mortgage, the brain registers it differently, as building something, even though a significant portion of early mortgage payments goes almost entirely toward interest, not equity. In the first 5 years of a standard 30-year mortgage, the majority of each payment services the lender's return, not the buyer's ownership stake. The emotional experience of the two transactions feels opposite. The financial reality is far closer than most people realize. There is also what economists call opportunity cost, the invisible expense that never appears on any statement. The down payment on a median American home currently requires somewhere between $40,000 and $80,000 in liquid capital. That sum, if invested instead in a diversified index fund at historical average returns, compounds meaningfully over the same 30-year period. The homeowner builds equity in one asset, in one location, subject to local market conditions. The renter who invests the difference builds a liquid diversified position, one that does not require them to call a plumber when something breaks or absorb transaction costs of 6 to 10% when they eventually sell. None of this means renting is always superior. What it means is that the decision is genuinely mathematical, and most people are not making it mathematically, they are making it psychologically, driven by the fear of impermanence, by social signaling, by the deep cultural equation that ties a mortgage to maturity and a lease to failure. That equation was not neutral when it was constructed. It was immensely profitable for lending institutions, real estate industries, and the broader financial infrastructure built around home ownership as the default. The more useful question is not rent or own. It is, what does this specific decision cost me in this specific market at this specific moment in my life relative to the alternative? That is a spreadsheet question, not an emotional one. And the people who answer it clearly, who separate the psychology from the arithmetic, tend to make choices that actually reflect their financial reality, rather than the story they were told about what financial adulthood is supposed to look like. Wealth, in the end, is not about which column your housing payment falls under. It is about understanding the full cost of every choice, the visible ones and especially the invisible ones.